And if they just trust what the needs analysis recommends for them, they don't really see a $250 as a lot of money, because it's not. It's only 5% of their income, you know? So the way I break it down for them, I honestly don't even, I honestly, I'm not scared to show them what they need. You know what I mean? Like, I don't think you should ever be scared to show them what that price is. If anything, it's price conditioning them right off the bat right there. You know, if you see sticker shock in their face, you know, like, oh shit, like I gotta change up my approach a little bit here, you know. But if they're ready to go for it, they're ready to go. I mean, I close people on $250 a month right there on the screen, just by showing them what they need, you know. So I would never shy away from it. I mean, some people do. Some people like, I'll work up some custom numbers for you. It's fine too. However you're taught to close is fine. I just do it the easiest way and the easiest way to repeat, because it's the same process every time, you know. And if they tell you at that point, yeah, that's not comfortable, you can always get A, B, and C at that point. You know what I mean? At least you know what their price range is. You know, it makes you more effective. All right, sorry guys, I know I lost you here. But Mason just had a question about during the presentation after this, where it breaks down the price for him. He was asking, show the price, and they froze again. So normally I do, right? I don't really shy away from it. This training is crazy. All right, but income protection. So this is something you're going to have to paint the picture on, right? Because this is like a feeling and an emotion. Like it's tied to their whole family. Like the way and if you watch the video on the e-app about income protection, it's like a great comparison. I make the comparison all the time. You compare the person's heartbeat to their paycheck, right? It's the same thing. Their heartbeat and their paycheck are the same exact thing, right? Because do you ever think about your heartbeat at all? No, right? It goes up, it goes down all the time. No, when's the only time you think about your heartbeat? When it stops, or you know, when you have some kind of irregularity in it, right? Same thing with your paycheck. Same thing with this union member's paycheck. It's going to come into this house every single month, right? Sometimes it might be, but it's going to come up and down. They might miss a paycheck, they'll be down. He might get a raise. He might have work overtime, and then he might be his hours cut back, right? Up and down, up and down, up and down. The only thing that's going to stop that paycheck is if what happens? Joe's heart stops, right? So making sure that Joe's, you know, $3,000 every single month comes into the house to pay for things like groceries, to make sure the lights are still on, to pay for the heating bill, right? To make sure the kids can still watch movies on their iPad. 3 to 5 years of his income is going to come out every single month. So every single month, his wife's going to get $3,000 in a check, so she can use that to buy things, keep the house afloat, right? Now, most people you're going to sit down with, both people are working. Husband and wife are both working, right? So you don't want to ask who the main breadwinner is in that situation. That's an awkward question, right? Because they're going to be like, I don't know, right? You want to ask at that point, do you guys rely on each other's income? And they're like, yeah, we rely on each other's income. Okay, great. So if either one of you passed away, it would be a pretty big burden, right? And they'd be like, yeah. If Joe didn't come home, you know, maybe if you missed one paycheck, you could get by. But if one was cut off forever, different story, right? And they're going to agree with you, right? You guys right here should, in this whole section, you should get like anywhere from like 15 to 25 yeses. You should get 15 to 25 small yeses in here with tie downs. That makes sense to you, right? You can see why I would be recommending that amount for you, right? And if you don't get like a verbal yes out of them, if they're like nodding their head, like, Joe, you kind of froze. Did you say yes? right? And I'll get them to say yes again. That's a little bit of control there too. So income protection is something that's very vital to most families. Now, I want you guys to realize as well, you're going to run into some people that have coverage, that have life insurance. They maybe have it through State Farm or Primerica, or, there's a number of different companies out there, right? But if they have coverage, right, and it's term, spend it here. Spend it. So what I mean by that is if Joe already has $200,000 of term through another company, spend it. Joe, good job getting that term. You know what you did? You just made sure that your income was protected, right? So you took care of one of those concerns. Great job. Great job, right? So he can't tell me down the road he has life insurance because I already spent it. Because really, guys, if you think about it, let's say Joe has this $200,000 term policy, right? And his wife, let's say Joe passed away and his wife dips into it and she takes out 30 grand for the funeral, for final expenses, right? Gives that right over to the funeral director. What's she left with? 170, right? What do you think is going to happen to that 170 as soon as that hits her bank account? It's tax-free. But what's going to happen to it is she's going to start spending it, digging into it. Right? Think about it. If, Mason, if me and you go to 7-Eleven, or let's say we just walk over to Speedway, right? And in Speedway, let's say we need like milk, eggs, and bread. It's like $15, something like that, right? And in my right pocket, I got a $20 bill, and in my left pocket, I have a $100 bill. Which pocket am I reaching into? $20 bill, right? That's the right answer to that question. Why am I using that? Why am I going to use the 20 though? Right? So what happens if I break the $100 bill? What happens when you typically break 100? You end up spending it, right? You buy dumb things you don't need just because you have extra money in your pocket. So that 100 signifies something to you that if you don't use the 100, you're not going to break it, you'll still keep it. This is the $100 bill. And then this is the $20 bill, right? The $30,000 in whole life. Dip into that to take care of the funeral. That way, all the income is still protected. Right? I just showed them how to have both and made it make sense. Don't fight an uphill battle here. Just spend their coverage on what they need. Does that make sense? All right, any questions on income protection? No? Okay. Let's erase some of this stuff. Where's the eraser at? You got a question, PJ?
No, I'm just, no, I'm good. I got that. I understand that.
Okay, cool. I mean, the whole point I'm trying to get across to you guys doing this is the product we have isn't tangible. It's not like a vacuum cleaner. I'm not selling them cleaning products. They can't like hold it in their hand, right? They can hold the paperwork, but they can't hold what life insurance is going to do for their family. It's a feeling, it's an emotion, right? And in order to bring that out, we have to use words like concern and problem, and we have to paint a very vivid picture of that family without Joe. Because chances are they've never thought about this, right? So let's erase this too so I can just really do the income protection again. Okay. Income protection. All right. Now, the fourth concern in the list of concerns is either mortgage protection, MP, or rent protection, RP. Either one. Either one works here, right? Once again, asking them questions here. Joe and Mary, do you guys rent or own? You own? Okay, great. You know how much you got left on the mortgage? Get me close. Like, if you build enough trust with them, they shouldn't have any questions answering any of this stuff. Because what you're doing is really, you're helping them here. They should see that. So if they're like, oh, we got about 150,000 left. Let's just say in the mortgage, they got 150,000 they owe. So what's going to happen to Joe is Joe's not going to be here anymore. Joe dies. Who's going to be on the hook for that 150,000? Mary is, right? And probably when they took that mortgage out, they were both contributing toward it. Or maybe Joe was paying more of it, right? They had income coming in to take care of it. But Joe's paycheck's cut off. Joe's not coming home. The bank, guess what they want? Same full mortgage payment you were paying before. The same exact payment. They're not going to lower it because one of your members in your house died. They honestly don't care. So why foreclosure rate's very high? Because people pass away. They were living a certain lifestyle and they couldn't keep up that same lifestyle. So they had to foreclose on the house, right? The main reason why it exists is because people don't have 150 grand to put towards a house, right? The mortgage protection is going to make sure that if something does happen, all that money could go to pay off the mortgage, right? I can't think of a better asset to leave your family than for them to own a house, right? That's huge. Especially if someone has the house paid off already. Whew. Right? It works the same way with rent too. Rent's not any different. You can ask them what the rent is every month. Your rent's $1,000 a month? Okay, great. It's 12 grand a year. Right? I usually project out 5 years. Right? So we're looking at like what? 60,000? $60,000. The person can live in that same apartment for the next 5 years, not have to worry about moving. Show them the numbers. Because these numbers right here are going to show people that there's a big need and a big concern. So you might have some people be here like, oh, I have mortgage protection through the bank. Yeah, they have what's called PMI, stands for private mortgage insurance. That doesn't protect them. That protects the bank, right? Because people, when they go get $150,000 or a $200,000 loan for a house, do you think that bank has 200 grand on hand to loan that person? No. Guess where they borrowed that 200 grand from? A bigger bank. PMI, private mortgage insurance. So when they take that big bank's money, the big bank makes them get private mortgage insurance on that. So if that person dies, that small bank doesn't have to pay the big bank back. Right? And typically they only make people get that who put less than 20% down. Right? Once you pay off the principal, they have that come off. Now, an easy way to ask your members if they have that is if they pay like an extra $50 to $80 for their mortgage every month. If there's another little charge in there every month, that's how they know if they have private mortgage insurance. Now, if they have mortgage insurance through State Farm or another company that's outside of their mortgage, then yeah, they might have it. It's rare. Okay. So, big concern for a lot of our members is they were passing away and their family couldn't keep up the mortgage payments. So, what they would do is make sure that, your entire mortgage is paid off, or at least that your family could still live rent-free for the next 5 years. Right? You see how kind of we're painting the picture and not really too concerned about the numbers. It's a concept of the house. It's a concept of them not having to pay rent, right? Because that's the first thing that's going to be on their mind. Once the funeral's taken care of, once the income's still coming in, where the hell am I going to live at? All right. So mortgage protection is usually pretty brief when you're explaining it to them too. It's quick. You can ask them, if you really want to get into depth with them about it, you can ask them, Mary and Joe, what's the most important thing you own? What's your biggest asset? And 99 out of 100 times, they're going to say the house. If they have a mortgage on the house, they're going to say the house. Right? So, and I would say, yeah, I couldn't think of a better asset than the house. Right? But unfortunately, Mary and Joe, who owns that house right now? And they're like, the bank does. And I'm like, you're right, the bank does own that house, right? But you're paying it off. If something happens to you, the bank's going to still want their money though, right? Yeah. Okay. So you want to make sure that that's protected. Right. So the one thing I want you guys to kind of do when you're in this situation is voice inflection is pretty big here. Like, I don't know if you guys realize the tone of my voice from when I started to when I'm now explaining this stuff. It's lower. It's slower, right? I'm more professional at this point, right? You want to make sure that they understand this stuff, because if you're doing all this great math here and they're confused as hell, they're not going to make a decision today. I've done it. I've confused the shit out of people sometimes, right? And I know it. I did it last week. I left the sit and I let a bunch of cuss words out because I know what I did wrong. I confused them, right? I thought he knew more than he knew, and it just confused both of them, right? So keep it simple with them there. Show them the amount that they have and let them know, hey, that's a huge asset that you have there. Let's make sure it stays with the family. Right? You worked hard to get that mortgage set up initially, didn't you? I'm sure you had to jump through a bunch of hoops to get it. Let's make sure it stays there. All right. Any questions, guys, on mortgage protection? No? Okay, good. All right. Now, the fifth concern is child education, debt, or a legacy. Hit fit a couple different things in here. Play to your audience in this one, okay? Mainly, it's kids' education. Like if you look at the list of concerns, it says kids' education or debt protection, right? But if you're sitting down with older people and they don't have any kids and or their kids are grown, that's not a concern. We've got to find a concern for them there, put it in there. Concern would be their legacy, leaving behind a legacy for their family. Right? But let's say that this family, Mary and Joe, they have 2 kids. Right? I would say, Joe, actually, typically when I talk about the kids' education, I usually go with the wife first. I don't know why, but a lot of time I just go with the wife. I would say, Mary, you want little Sally and Susie to go to school, right? They're like, yeah. Every parent says, yeah, I want them to go to college.
So if they don't have kids, would you just turn that into straight
debt?
Like, do you have debt or?
Mm-hmm. Yeah. So good question. Yeah. So, and I'm going to get to that in a second. Now, with the kids' education, you want to project what school is going to cost, right? Some of us have been through college. Some of us have paid for college. It's expensive, right? I went to school about, it'll be 10 years now since the last time I was in college. I graduated in 2011. So when I left school, I owed about 80 grand. I was there for 5 years, right? Nationwide average for a 4-year university is anywhere from $50,000 to $100,000. Right? You can get away with in-state a little bit cheaper if the kids go to like a community college before for 2 years and after, right? But what I always tell the parents here is if you're not here, at least give them an opportunity to choose. Give them an opportunity to go to school or open up a business if they don't want to go to school, or maybe go to trade school or something like that. Like, this is an opportunity for your family to do things better. And when you ask parents, they always want their kids to be better than they were, right? It's not, they're never gonna be like, nope, I didn't do this, so my kid ain't doing it. They're gonna be like, I didn't do this because my raising wasn't great. I'm gonna make sure that my kid does this, right? They're more motivated to do it. So when you're talking about education with the kids, you wanna break off how many kids they have. So for Susie, it's gonna be 100,000. And then for Sally, it's gonna be 100,000 as well, all right? So about $200,000 you would need to make sure that the kids' education was protected in case either one of you didn't come home. That makes sense, right? Yeah, probably more. You're right. Especially, well, unless they get scholarships and things like that. Yeah, unless they're getting scholarships and crazy things like that. So, I mean, at that point, you kind of just want to let them know, like, hey, the statistics are that if either one of the parents dies, that child is like 80% less likely to go to school. It's not good.
So with inflation, I know you probably the final expense, gonna go up, school's gonna go up. I mean, with inflation, with a mortgage ain't gonna go up, because that was just the payment of the land.
Correct. The mortgage won't go up. They might refinance the mortgage.
Right, but then even the income protection, those two are just facts of what you had.
Because typically their paycheck's going to rise with inflation. They'll make a little bit more down the road. So paycheck's going to be kind of a steady thing. Same with mortgage protection. It's kind of a fixed amount. These two, you're right, are going to be a little bit variable. Right.
With debt, would you have them try and list everything and what they're in debt with?
I would, yeah. I mean, typically, yes. I would ask them like, so now with debt, guys, do you guys have any like crazy outstanding medical debt or credit card debt or student loans or anything like that at all? Right, because you got to remember where debt's going to go. Like if this is debt for them, their debt is going to go to their family. There's debts that are forgiven, and there's a lot of debts that aren't. Right? Typically, school debts aren't, hospital bills aren't, credit card bills, car loans, things like that. Right? So yeah, I would have them list the bigger ones. Now, if they have like $5,000 on a credit card, I gotta put $5,000 on there, right? But if they're like $20 in debt to, I don't know, the school, they have another $50,000 in debt to the medical bills, right? Definitely list that, because it just shows them visually where they're at. They know that they're in debt, right? Not a lot of people are going to tell you that they're in debt. They don't want to say it. But if you bring it up to them, like, yeah, this will protect your debt and make sure it doesn't get transferred to your family. Or do you guys have any like crazy outstanding debt, like credit cards or anything like that? And they'll tell you, like, oh yeah, I like $7,000 on my Visa. I got a car loan for another $20,000. Okay, that adds up to 25. That's good. Not a lot. You want to make sure that they understand, like, that's a lot of money, so they can live basically, but they want to make sure that doesn't get transferred to their family. But the debt is kind of like few and far between. It's on there for sure. But most people you're going to do is kids education or grandkids education, something like that. And then the other one would be like a legacy. So that would be with like an older generation where they might not have anybody relying on their income, or they might have the house paid off. The one thing they want to leave is a legacy for their family. Right? And a good way to like introduce this is you can ask them, Joe, if you pass away tomorrow, would you want to leave a liability or would you want to leave a legacy? He's never going to tell you liability. Never. It's always going to say legacy, right? And I would say, Joe, this would be a way to make sure that you could leave each one of your grandkids $10,000 when you passed away. Right? If he has more grandkids than that, break it up. Right? And what you guys would do, and if you wanted to quote it for him or build it into a price, you could do it in, depending on his age, you could do it in whole life to make sure it definitely comes out for the kids, or Head Start programs. Getting the grandkids taken care of right then and there. That's the whole life for the kids, right? So the third, like I said, the fifth concern is kind of a bunch of different ones in there. Customize it to the person you're sitting with. Make it make sense to them, okay? Now, do you guys have any questions about kids' education, debt, legacy?
I think I understand it.
Good.
So in the order when you're explaining this,
Mhm.
you'll go over, most of all of our union members seen these problems. You explain that, and then would you also like compare their personal life to it after you explain like the union members and why these reasons have came up? So like, with people in the unions, they've seen that, their funerals were way too much when they were dying with guns to their family.
Mhm.
And then you can go, now Joe, like if you were to die tomorrow, if you were to die tomorrow, would you want this money to be carried over and be a burden on your family? And would you ask that for all four reports parts after comparing them to the union members, bringing up the problem?
So I do a rate as I'm going over with. So I'm going to be, 30, and you having, right?
Now, if it said 20 to 30, would you the extra 20 to double it and maybe find more of an ALV?
Yeah. Yeah, for sure. Yeah, especially if they're gonna outlive that. If they got more than 20 years in them, if they got 40 years in them, like if they're in our age bracket typically, like anywhere from age 30 to age 40.
Then you'll just go off of that. And not
I'll
overcome.
say what's gonna recommend is probably about 40 to 60,000 for you. All right. Areas. Right. So when you're explaining this to them and using their numbers in here, and then it pops up on the screen, the expert trader recommends the same thing that you just
Drew, can you hear me? Oh, you're on mute, Drew. You're on mute there. Drew, can you hear me? Drew, come on.
I don't have a video right now.
I can't hear you. I'm sorry, I was muted. What's
Okay,
up?
yeah, now I can hear you. Kwame, can you hear? Yeah, you can hear.
Yeah, I can.
Okay.
Okay, no, keep asking them. So I don't know, you got, I kind of got cut off there. What Mason asked was, when I'm explaining this, do I just show them or explain to them the paint the picture there, or do I put their numbers in there? I use their numbers, what it would kind of recommend for them, right? So that they have their defined picture for their family, right? Now, if you want to do it to where you kind of just run through them really quickly, you're not going to have the success you're supposed to have, because this is a very important part, is painting the picture with them. You're going to probably want to spend 10 to 15 minutes here going over this with them. Might be a little bit longer. But if they understand this and understand why they need it, they're going to keep the policy. Like, you guys realize that people buy things that they don't need all the time because they like it. Serves no purpose in their life, but they buy it because they like it.
And before you get into the needs, is this where it would be a good idea to say that? So let me ask you this, Joe, with $5 every $100 you spend.
That would be like after the needs analysis. After you, yep, after, because the needs analysis breaks down their coverage, breaks down their price to 5.5% of their income. So that's why you ask $5 to $6.
I was practicing saying that like right after I explained this. So I was
You could do that too. That's
so
that's a
we're
perfect spot
not
for it.
here to be a financial burden on your premiums. We're just here to help you when that financial burden comes.
Yes. I mean, that's good wording for it, for sure. You want to say that, like, and I'm going to show you how to kind of wrap this up and bring it into the needs analysis, right? That's the next thing we're going to do. So after you get done kind of explaining all of this to them, and let's just say in this instance, like, they have all four of them, right? Let's say Joe's 5 years of Joe's income is, I don't know, $125,000, right? And they have two kids that need 100,000 for school.
So what about with like,
And then they have a mortgage for 100,000. We'll do this, make it easy.
What if like with the income protection, what if he's single and he lives in the house by himself?
I'm gonna go over that in a second. I got you. Check this out. So if this is a case where it's two families, or it's one family with, husband, wife, two kids, all right? At this point, I went over everything that I went with them. I broke it down for their coverage. The next question I'm going to ask is one of the most important questions you're going to ask them. You're going to say, now, Joe, if you did not come home from work tomorrow, or if you died tomorrow, Joe, and you can make sure that the final expenses, the income, the mortgage protection, or the kid's education was protected, which one would you say is the most important to you? Make them pick. Make them sell themselves right here. After you ask that question, don't say anything. Wait till they respond. Because what you're getting them to do is sell themselves on their favorite benefit. What makes most sense to them, right? What's important to them. So let's just say Joe says income protection. He would say, my income, Drew. I would circle it. And then I'd ask him a question. I would say, Joe, you said income protection, right? Why would you say income protection, Joe? And he'd say something like, oh, my family relies on my paycheck, and, if I wasn't here, they need that money. I'm like, you're right, Joe. Your paycheck's very important. But why would protecting your income be important to your family? What does it help your family do? It helps them pay the bills and make sure that they can live a comfortable lifestyle, right? So your lifestyle, Joe, would change if you did pass away, right? So see how I went like 3 steps deep into that one? I didn't just ask him which is the most important and said, okay, great, and circled it. I want to know why, right? And if he says something like, my paycheck is important. Joe, what does your paycheck do for your family? Get him to sell himself on why it's important. And then I asked the same exact question to Mary. I say, Mary, God forbid something happens to you and you could choose one of these as well. Which one would you say is the most important to you? And then I'd be like, I don't know. They're all important, Drew. I'm like, I know they're all important, to be honest with you. You have a need for all of them. But let's just say you could only pick one. Make them choose one. And to be honest, guys, the two most important ones, or two that people are, I don't want to say most important, but 2 most common ones people are going to pick are these 2. Mortgage protection and income protection, right? Because these are 2 physical things. Their paycheck they see every single week. The house they live in every single day.
Mortgage and child, I see why that's important for like the families. But how would you just cross off income protection if they were single?
Yeah. So Mason asked if somebody was single, how would you go about doing this? Same way, right? Let's just say this guy was a single person, and let's just say he was a single person, right? And at this point, he lives with his mom, so he doesn't pay rent, right? Single guy, say he's 30 years old, right? He's still going to have final expense, right? I would still write income protection, mortgage protection, and kids' education. I would still write them out because those are still concerns, right? I would show them, hey, 10 to 15,000 nowadays for your funeral, 20 years down the road, 20 to 30, and you're in the same age bracket I am there, Joe. So probably down the road, we're looking at like $40,000 to $60,000 for a funeral. And if you think about it, that's like a brand new Audi, right? Brand new Audi to pass away. And he'd be like, okay. And I'd be like, Joe, is anybody relying on your income right now? You go, no one's relying on my income. I live at the house and I don't have anything going on. There's no one relying on it. I'd be like, okay, great, cool. So not too big of a concern for you right now then. Great. And then you said you live at home with your mom, right? Do you help her pay rent at all? You do? Okay, good. What do you help her pay every month? I get an amount. Right? If it's $200 a month he pays in rent to his mom, project it out a couple years. Make sure she can live in the house still. If not, cross it off. And then use this one for debt for a young person with no kids.
Would it be a bad idea showing them the problems with union members and then even drawing it in their own way of this is their chart and I could show it to them on a piece of paper through Zoom instead of just using the PowerPoint but going
You
on with
can.
family members so they remember it?
And Zoom, I don't know if you guys know this, but if you go to share screen in Zoom, there's a whiteboard on there. It'll just bring up a white screen. You can draw right on that white screen.
I never knew that.
Yep. That's sometimes how I do it too. Because I mean, when I was doing the presentation, I would do this in a house with them. And if you look on eApp, there's no part where it pulls up this at all. So I would draw on pen and paper, just show it right to them, break it down every one of their needs right in front of them.
How do you get to that whiteboard? You just say with the.
Yeah, you just when you're on Zoom, you just go to screen share, and then it just says whiteboard. All you gotta do is click on the whiteboard. It'll bring us up. We can just draw on whatever you want on it. All right. And then this will save too. You can save these and send it to them if they want it.
Is there like a way, when you're in the whiteboard, how do you get rid of it and go back to the PowerPoint?
Just share screen again and go click on the PowerPoint.
And
Yep.
we'll just completely get rid of the whiteboard?
Mhm. Yep. Practice it. Just so when you first time you don't do it, you're like, oh shit, I don't know how to do this. Yeah, practice it. But yeah, if this kid doesn't have anything, he's only got final expenses, circle final expenses. And I'm like, looks like, Joe, you really only got one problem, one major concern. Out of all the concerns, you really only have one to take care of now. If you make sure that no one's going to pay for your funeral down the road. All right, and then I go right into the needs analysis. I wouldn't even really ask them the question. You know, what's most important? I would just
If you drew
assume
that
it.
out on that whiteboard with their own, you'll probably be able to just, you're gonna ask the same questions on the needs, but you're probably gonna be able to fill it out. As you point out, be like, yes, you told me you still had a 30-year mortgage.
correct. And the thing too, it's and Vince is going to go over this in the last day of training with you guys, is singles versus seniors. When you're sitting down with a single person, you got to remember, like, they're only concerned about what's in it for them, right? They don't have a family. They're not too concerned about projecting rent payments or things like that. They're worried about, what is this going to do for me? Why am I getting this? So at that point, we want to show them cash value and paid up options, because that's what they're going to get. They're going to build cash value and they're going to build paid up options. So typically with someone who's single, you want to keep the quotes that you give them typically in whole life, because it's going to build value for them. And they're going to see that. That's what they want to see. Why are they doing it for them? Right? You got to also nail home, if they're a single person, someone's going to pay for their funeral. You might get some people who are very stubborn, like, I don't care who pays for my funeral. Well, I've been in a house before, and I've called people selfish. Like, the guy was rebuttal. Yeah, I mean, kind of. But like, someone needed to tell him that. He told me that his brother was going to pay for his funeral. I was like, your brother's going to pay for your funeral. Your brother got 30 grand laying around to pay for your funeral. He's like, yeah, he can do it. I was like, have you talked to him about this? Does he know he's doing this? He's like, no, but he'll do it. All right, that's comfortable. If you're comfortable leaving your debt on somebody else, in my mind, that's kind of selfish. I think that's what I said. In my mind, I think that's kind of selfish. But, and then, I mean, there's just some people you can't win with, you know, not a lot. And that's our job, is to paint that picture so we can win. All right. Yeah, no problem. But that's typically, at that point there, we would roll right into the needs analysis with them. Right? On the eApp itself, the needs analysis, the top part of the needs analysis is going to be where we would put the information for their discount card, right? Right after that, that's the actual needs analysis. And Josh went over a little bit of that with you guys, right?
Is the first one referrals?
The first thing that pops up, I believe so, is referrals, yeah.
So, but then there's referrals for people who would, is that for people who want coverage or to work with?
That one, first one is for recruiting referrals, and the next one is for actual referrals.
So it goes recruiting, other referrals, then medical card.
Mm-hmm. Yep. That, you know, ordering the app. Now, with the list of concerns, the last concern is affordability and being able to qualify for the program, right? So actually being able to afford it And the good thing about our program is that needs analysis, like I said, breaks down their coverage to 5.5% of what they bring home monthly. So Mason asked the question earlier, and it was a really good question. When do I use the $5 to $6 question? Right? The $5 to $6 question is, Joe, if you set aside $5 to $6 out of every $100 that you brought into this family, and you set that aside every day, and you knew that if you didn't come home, that the other, 95 or 96 or 94% was taken care of, would that $5 to $6 drastically change your lifestyle or take food off your table? They might say, yeah, $5 might be a little rough. We got to remember, it's $5 out of every $100 that they bring in. It's 5%. So when you really break it down to people and they're making $5,000 a month, like 5% is nothing to them. They're probably spending 5% on things they don't need. Their cable bill is way more than 5%, right? So the reason why we ask that question is, once again, price conditioning on them at that point. If they say, yeah, that might be a little bit rough, no problem. They even have programs that are $1 a day, right? Flip it around to a positive. But the needs analysis itself is going to recommend coverage based on 5.5% of what they bring home. Just know that. Now, if the needs analysis shows that they only need one thing, it might be less than 5.5%. Or if they're younger, it might be way less than 5.5%. But just want you to know, when the needs analysis pops up, guys, just so if you're like closing on the computer, just know that typically when it's going to do when it's going to do final expense protection, FE, it's going to typically recommend whole life. That's what it's going to typically recommend for final expenses.
It's never going to recommend term in the needs analysis.
Not for final expenses. And it's typically going to recommend $30,000, just so you know what it's going to pop in there.
It would probably recommend term if they had like 2 years left on their mortgage.
Yep, that's what, and then it would say income protection, IP, right? Typically, they're going to recommend term for that. Typically, it's going to be a 10-year RNC, right? For whatever value it is. So RNC stands for renewable and convertible. So our term policies are a little bit different than most companies. They're actually better, because with most term companies, at the end of those 10 years, so this 10 years goes by, and if they want to keep that policy, the price is going to bump up. And number two, they have to requalify right here. With most companies, if they can't requalify, they don't get the coverage anymore. But because our policies are renewable, every 10 years, it's automatically going to renew. They don't have to answer them health questions. It's just automatically going to bump up. Now, it's going to be more expensive for sure, but the fact of the matter is their health is locked in. That's the big thing. And then C for convertible means that anytime within these 10 years, they can convert this policy to a whole life policy and it'll stay level for them. They'll just convert, let's say they had $100,000 in term, they convert it to a whole life, they'll keep that $100,000. Now, it'll be more expensive than the term would be. It'll be at the whole life rate. Still, they would still get to keep it. It wouldn't go up or go down, right? But good question. And then if you guys want to know like the policies we sell and the products we have, if you have a rate book, I don't know if you have them, there's a virtual rate book I can send you guys. The second or third page goes over, it's the third page, goes over all of the products we have. And it'll give you a good description of every single one of them too. So, but just know the income protection is typically going to recommend a 10-year renewable convertible term for whatever they have. Right? Mortgage protection is typically going to be either a 30-year or a 15-year decreasing term. Right? which means that they'll have a term policy that will go down. So the cost of their mortgage is going to go down, right? And the policy is going to go down as well. The price won't go down. The price will stay the same. The value will go down to where they meet at the end. So once they paid off their mortgage, there's no more life insurance needed and everything stops, right? So you'll see it'll be a little bit cheaper in the beginning because they have a lot to pay for in the mortgage payments. But as the mortgage payments go down and they initially get to zero, the coverage would stop and the payments would stop. All right. Now you can cover mortgage different ways. They might also do mortgage if they recommend it. If they're younger, they might do with accidental. They might have them cover the mortgage with $100,000 accidental. But a lot of it depends on how much they owe on the house. If it's a bigger number, it's typically going to be this one. If it's a smaller number, it's typically going to be that one. Okay. And then the last thing that's going to pop up is child education. And usually this is accidental death benefit. Unless the kids are really young, if they're like 3 or 4 years old, it's going to recommend like a 20-year level term. Because if something happens in the next 20 years, all that money would just go to pay for school. If they outlive the 20 years, the husband's still there, the wife's still there, they can figure out the education. That's just if they don't come home, right? So the one thing I would recommend is doing the needs analysis over and over and over again with different examples. Practice it, right? I can even send you guys like a Dropbox of old practice assignments that I used to do. It has like everything you need to do to complete a full application. It's a lot, right? So I just want to leave like the last 20 minutes or so for questions from you guys, right? No, you're good, man. I'm here for that. I'm here for you to ask questions. So once again, just to kind of recap everything that we went over before we go over that, I want to make sure I didn't miss anything. Okay, good there. Okay. Yes. All right. So just to recap, guys, most important part when we're trying to close somebody, or I wouldn't even say close somebody, but explain to them why they need the benefits and paint the picture, is the pie chart, is the list of concerns, right? It's very important that you go over that with them. You cannot skip that part in the presentation. Even if they're like, oh, I know I need life insurance. I need it. We just need to figure out amount. Still go over that with them. Main reason why is, like I said before, people will buy things that they like, but they'll end up keeping something that they understand. Right? So I don't want you guys to get bogged down with the numbers. I want you to pitch concepts. The concept of final expense protection. Not it costs $20,000 to bear you. The concept of it, right? The concept of Joe's paycheck still coming in every single month. Not $150,000 in a 10-year term, right? Because people aren't going to remember. Like I go see POS all the time. And they're like, I don't know how much I have. I just know that if Joe passes away, his income's protected. Because someone told them and coached them to understand that that's what it's for. And that's why they kept it, because it's protecting his income. Right?
The only thing I'm nervous about this is whenever they tell me that they do have coverage. And I don't know how to like, well, I guess that's going to be what the needs is for, because you're going to put it in there. But I wouldn't know how to like, oh, well, if you have this coverage, it's going to cover you on this, but it's still going to recommend this. But I guess the whole needs is going to do that. Yeah,
it'll let you know. Right. And what I would recommend, and that's a good point. So Mason said that the only thing he would be kind of nervous about is if the fact that they already have coverage. Like, how are we going to get them to number one, know what type of coverage it is, right? And number two, where am I going to put it at? Right? The first thing, there's not like a master spreadsheet that says this company does this type of policy, right? You're going to have to do it through like trial and error. So what I would recommend is every single sit that you're in, if someone tells you they have life insurance through a certain company, write the company down and just do a little bit of research on it. Type it into Google, go to their website, look what kind of policies they have. You can find most companies' policies just right on the website. It'll tell you they do group term, or they do accidental coverage, or they do whole life, or graded whole life, or you'll see a lot of different things on there. That's the only way that I became an expert, is I wrote a lot of stuff down. So I know now if someone tells me they have State Farm, well, I know it's either term or universal. They don't typically do whole life, right? I know if it's Primerica is exclusively term. They don't have any whole life, right? So I know where I'm going at that point.
When you're in the in-house, this guy, this, when you're building your report, is it okay to have a piece of paper and write in front of them, or do you want to keep it in your head?
No, I write it right down. I take notes.
I didn't know if that would look.
I think it looks professional. Because I mean, at the end of the day, you're really trying to help this family, and you gathering information is helping them, right? In my eyes, I think. And now I've never really had anybody say anything about it either. Normally, I just like take a couple notes, like I have like a Padfolio like that, and just a couple notes in every sit.
In your laptop, the presentation is turned towards them, you're just explaining to their face and then clicking.
100%. 100%. Yeah, if you're doing it in home, it's a little bit different. I wouldn't even worry about the PowerPoint. I would just present to them, like the no cost benefits, just presenting it right to them, you know. But if you want to use the slides, you can do that too. That doesn't matter one way or the other on that one. But hopefully that kind of answered that question there. Okay. PJ, any questions for me, man?
I'm good right now. You know what? Actually, I do have one question.
Sure.
When you were going over the child education portion, I didn't really understand what you meant with, I understand the legacy portion, but not the debt.
The debt. Okay.
The debt portion of the child education.
Gotcha. Okay. So now this goes back to like estate planning and going into your estate.
He said the debt of the child education, it's one or the other. It's not, you know what I mean?
Yeah. So are you confused, like that I put all of them together, or just about the debt section of it? Like where it would
Yeah,
come
like
from?
how do you help sell that part using the word
Okay.
debt? Because I don't really get it.
Gotcha. I understand the question now. So yeah, so you got to kind of go back to find out where the debt is going to go. If that makes sense. So let's just say in this instance, Joe, he passed away and he had, I don't know, $20,000 in credit card debt, and then another $20,000 he owed on miscellaneous stuff. So when he dies, that debt goes to his estate. Right? All the debt that he owes goes to his estate. Your
Oh, so
estate is
it's
all
not
the
specifically like education debt. It could be just any debt.
correct. It could be any debt. Any debt.
Okay.
So as like an executor of an estate, you have to pay off that debt before your family gets any of them a deposit, right? So when people die, the negative and the positive go together to their estate, right?
Okay, I
And
get it now.
you got it? Okay.
Yeah,
cool.
I didn't know if it was specific to education or not.
No, it could be any debt, because there's some debt that's forgiven and there's a lot of debt that isn't.
Mhm.
So you just want to make sure that the debt's that's forgiven. Sometimes like private school loans, things like that. There's all kind of other things. There's a bunch of medical loopholes.
Die just diminished.
Yeah, I mean, honestly, you brought the debt into the world to go into the grave with you too, in my eyes. But unfortunately, if that were the case, then America would be a little more broke or bankrupt than we already are.
I wonder if people, right, while they're on their deathbed, if they just claim bankrupt.
I'm sure some people have tried it. But I mean, that's kind of the basics of what I wanted to go over with you guys today. Like a very important part in the closing process, making sure you get them to sell themselves on the benefits. And then the transition over to the needs analysis is pretty easy, right? So we went over the major concerns that a lot of you union members have. Now, what they designed to make sure those concerns are addressed for you and your situation is a needs analysis. So have you guys ever been to a financial advisor before? No? Okay, great. Well, this is actually going to be like a little financial advisor for you. What I like about the needs analysis the most, this is what I tell them. What I like about the needs analysis the most is it takes into account everything you have going on in your situation, and it's going to let you know if it sees gaps in any coverages. If it sees gaps, it'll recommend some things, and if it doesn't, it won't. And then based on those recommendations, we'll see what we're able to help you with today. Right? So I did a couple things there. I let them know that if I can't help you, I'm not going to hurt you, Because if there's no, the needs analysis will know if they don't have any gaps, it won't show anything. It really won't. But if it does see gaps, it's going to recommend some things. And then I said, based on those recommendations, we'll see what we can help you with today. Sense of urgency. We're going to do it today, right? So, I mean, other than that, guys, I really don't have kind of much else to go over with you here. I will send you guys the Dropbox so you'll have examples of the homeworks. PJ, who's your manager?
Casey.
Casey? Okay, I'll send it over to Casey. And Kwame, I got you on yours. All right, no other questions, guys?
Thanks, Drew.
All right, guys. Go out there and kill it today. Have some fun with your clients.
Appreciate it.